Good evening. Today's report focuses on a growing dispute that could reshape North America's economic balance and trigger wider supply chain stress. Reports suggest that during recent private discussions, Trump demanded that Canada sell key natural resources to the United States at prices below market cost. These resources reportedly include energy products, critical minerals, and industrial inputs that are essential to manufacturing, agriculture, and infrastructure. According to multiple reports, Trump argued that Canada benefits heavily from access to U.S. markets and security guarantees. Based on that view, he allegedly pushed for discounted pricing on Canadian resources, suggesting that Canada should accept lower returns as part of a broader economic relationship. Canada is a major supplier of oil, natural gas, uranium, potash, timber, aluminum, and critical minerals used in electric vehicles, defense systems, and technology manufacturing. Selling these resources below cost would mean Canada's producers operate at a loss or depend on government subsidies to survive. Canadian officials reportedly pushed back, stating that resource pricing is governed by contracts, market forces, and international trade rules. However, the demand alone introduced a new risk: the possibility of trade coercion rather than negotiation. To understand why this issue matters, it's important to understand how modern supply chains work. Resources are not just commodities, they are the foundation of industrial systems. Oil fuels transport, potash feeds crops, uranium powers nuclear plants, critical minerals drive electric vehicles and advanced weapon systems. If a major supplier is pressured to sell below cost, production slows, companies cut investment, exploration declines, maintenance is delayed. Analysts warn that below-cost pricing discourages long-term supply stability, and when supply stability breaks, shortages follow. Following the reports, energy and mining stocks in Canada showed volatility. Some companies delayed expansion plans, others issued cautious guidance to investors. Currency markets also reacted. The Canadian dollar showed mild fluctuations as traders weighed the risk of trade confrontation. At the same time, U.S. manufacturers quietly expressed concern. While cheaper inputs may seem beneficial at first, analysts warn that unstable suppliers create long-term risk. Short-term discounts often come at the cost of long-term reliability. This is where the supply chain crisis begins to emerge. Supply chains rely on trust, predictability, and fair pricing. When a major buyer pressures a supplier, the supplier looks for alternatives. Reports suggest Canadian policymakers have already increased discussions with Europe and Asia about diversifying exports. If Canada shifts supply away from the U.S., American manufacturers may face shortages, delays, or higher costs from other sources. Analysts warn that pressure tactics often backfire, triggering exactly the disruptions they aim to avoid. One of the most concerning elements, according to analysts, is the lack of a clear exit strategy. If Canada refuses to sell below cost, trade tensions may escalate. If Canada accepts, domestic backlash could grow, and producers may reduce output. Either path carries risk. Experts note that successful trade negotiations usually include compromise and defined end goals. In this case, reports suggest demands were made without outlining how stability would be restored afterward. That uncertainty feeds instability. For Canada, the implications are serious. Selling resources below cost could weaken public finances, reduce employment in resource regions, and limit future investment. It could also set a precedent. If one trading partner demands below-cost pricing, others may follow. Analysts warn that economic sovereignty is closely tied to resource control. Canada's ability to fund healthcare, infrastructure, and defense depends in part on fair returns from its natural wealth. For the United States, the risks are different but equally significant. Short-term gains from cheaper imports may be offset by long-term shortages. U.S. industries depend heavily on Canadian inputs due to geographic proximity, shared infrastructure, and regulatory alignment. If trust erodes, rebuilding alternative supply chains takes years, not months. Analysts warn that industrial resilience cannot be built through pressure alone. Beyond North America, global markets are watching closely. Europe, already dealing with energy security challenges, may see an opportunity to deepen ties with Canada. Asian economies seeking stable suppliers may also move quickly. If Canadian resources are redirected, global pricing structures could shift. This could mean higher prices elsewhere, new trade alliances, and increased competition for limited supplies. This situation unfolds during a period of heightened global tension. Supply chains are already strained by conflicts, climate disruptions, and rising protectionism. Analysts warn that using economic leverage as a political tool increases systemic risk. Once trade becomes weaponized, cooperation becomes fragile. Analysts outline several possible scenarios. Canada formally rejects any below-cost arrangements and accelerates diversification. Negotiations stall, creating prolonged uncertainty. Retaliatory trade measures emerge. Supply disruptions slowly spread through manufacturing sectors. None of these outcomes are ideal. Experts emphasize that predictable trade relationships are the backbone of economic stability. History shows that aggressive trade demands often lead to unintended consequences. Previous trade disputes resulted in higher consumer prices, job losses, and slower growth. Analysts note that economic pressure rarely produces lasting cooperation. Instead, it reshapes alliances. For everyday citizens, this could mean higher energy prices, increased costs for food and consumer goods, delays in manufacturing and construction, slower economic growth. Supply chain crises do not remain abstract. They reach households. As reports continue to emerge, one thing is clear. Resource pricing is not just a trade issue. It is a stability issue. When demands replace dialogue, uncertainty grows. When supply chains fracture, everyone pays the price. The question now is not only what will happen next, but what kind of trade relationships the future will be built on. Should economic power be used to force concessions, or to strengthen cooperation in an increasingly fragile global system? Let us know what you think. As this situation continues to unfold, one reality becomes increasingly difficult to ignore. Modern economies are deeply interconnected, and pressure applied in one place rarely stays contained. What began as reported demands over resource pricing has now grown into a broader conversation about leverage, dependency, and the limits of economic power. Reports suggest that the request for Canada to sell key resources below cost was not framed as a temporary measure, nor was it paired with a clearly defined long-term plan. Analysts warn that this absence of structure is what transforms a tough negotiation into a destabilizing force. Markets, industries, and governments rely on predictability. When predictability disappears, caution takes its place, and caution slows everything down. This moment matters because it touches the foundation of how trade relationships function. Trade is not only about buying and selling. It is about trust, reliability, and shared expectations. When one party signals that pricing should be determined by pressure rather than cost, investment logic changes. Companies hesitate. Long-term planning weakens. Supply chains begin to fracture quietly, often long before the public sees visible shortages. For Canada, the challenge goes beyond revenue. Analysts point out that natural resources are not just exports, they are strategic assets. Their value lies not only in what they earn today, but in how they support national stability tomorrow. Selling below cost may appear manageable in the short term, but over time it reduces the ability to maintain infrastructure, support workers, and invest in future production. Once capacity declines, it cannot be easily restored. At the same time, this situation highlights a paradox for the United States. While cheaper inputs can reduce costs temporarily, analysts warn that dependence on weakened suppliers increases vulnerability. A supplier under pressure is more likely to diversify, delay shipments, or exit certain markets entirely. In that sense, short-term economic advantage can quietly evolve into long-term strategic risk. This could mean that the very supply chains meant to be strengthened instead become more fragile. Manufacturing depends on steady flows of materials. Energy systems depend on reliable inputs. Agriculture depends on predictable fertilizer supplies. When uncertainty enters these systems, it spreads quickly, raising costs and lowering confidence across entire sectors. What makes this moment especially sensitive is the broader global context. Supply chains are already under strain from geopolitical tensions, climate-related disruptions, and shifting trade alliances. Analysts warn that adding new stress through aggressive economic demands compounds existing weaknesses. The system does not reset between crises, it absorbs them layer by layer. Another critical issue is precedent. If one major economy successfully pressures a partner into selling below cost, others may attempt similar tactics. Over time, this could erode the market-based pricing system that underpins global trade. When prices no longer reflect cost and risk, production decisions become distorted. Some resources are overused, others underproduced, and inefficiencies grow. This could mean more frequent shortages, sharper price spikes, and increased competition for remaining stable suppliers. In such an environment, cooperation becomes harder, not easier. Countries begin to prioritize self-sufficiency, even when it is more expensive, simply to avoid vulnerability. Analysts note that this trend often leads to slower growth and reduced innovation. The lack of a clear exit strategy remains one of the most troubling elements. Successful negotiations usually define what resolution looks like. In this case, reports suggest that the end goal remains unclear, without a shared understanding of how stability will be restored. Each move increases tension rather than resolving it. This uncertainty also affects public trust. Citizens in both countries are left wondering how decisions made behind closed doors might impact their daily lives. Energy prices, food costs, and job security are not abstract concerns. They shape household budgets and long-term plans. When people sense instability, spending slows, and economic momentum weakens further. Analysts also warn that once supply chains begin to shift, reversing course is difficult. Infrastructure investments, trade agreements, and logistical networks take years to build. If Canada accelerates diversification toward Europe or Asia, those ties may become permanent. In that scenario, even if tensions ease later, the old balance may not fully return. This situation also raises questions about the future of economic diplomacy. Is pressure becoming the default tool, or will dialogue regain importance? History suggests that durable trade relationships are built through compromise, not coercion. While pressure can extract concessions, it rarely builds loyalty or long-term cooperation. What this could mean for the global system is a gradual move away from integrated supply networks toward fragmented blocks. Analysts warn that such fragmentation reduces efficiency and increases the risk of simultaneous shortages across regions. When everyone competes for the same limited supplies, volatility becomes the norm. There is also a strategic dimension that extends beyond economics. Resources like uranium, critical minerals, and energy